All right, let's get right into it. In the world of investing, there's one single concept that, once you really get it, changes your entire approach. And that is the simple but super powerful difference between price and value.
So, let's kick things off with a question. You see two stocks. One is trading for $500 a share, the other is $50. Which one is more expensive? Now, I bet your first instinct is to point to the $500 one, but stick with me, because by the end of this, you'll see why that simple answer could be a really costly mistake.
It all boils down to this, right here. Price is just what you pay. It's the number you see flashing on the screen. But value is what you actually get. It's the real fundamental worth of the business you're buying a piece of. And confusing these two is probably the single biggest mistake that investors make. To really get a handle on price, we need to meet the guy who sets it. So I want you to imagine the stock market isn't some cold, faceless machine. Instead, imagine it's your business partner. A very, very emotional business partner. The legendary investor Benjamin Graham actually gave him a name, Mr. Market.
Okay, so here's the deal with Mr. Market. He is incredibly moody. Some days, he's totally euphoric, he's on top of the world, and he'll offer to buy your shares from you for way more than they're actually worth. But then other days, he is in a complete and utter panic, and he'll try to sell you his shares for just a fraction of what they're worth. The price you see every day, that's just Mr. Market's mood.
So you can basically think of the market price as Mr. Market's mood ring. It changes color based on the latest news headline, on fear, on greed. It's emotional, it's totally unpredictable, and honestly, a lot of the time, it's completely irrational. It tells you how the market feels, not what a company is actually worth. And this is where value comes into play. Intrinsic value is the total opposite of Mr. Market's wild mood swings. It's the calculated real-world worth of a business. It's based on solid things, like its assets, its profits, and its actual potential to grow. This is the number that doesn't just change because of one bad news day.
Okay, so if the price is just a bunch of noise, how in the world do you find the real value? Well, you have to become a value detective. And just like any good detective, you're going to need a toolkit to help you find the clues.
And here they are, the three main tools in your detective kit. First, we have the price-to-earnings ratio, or PE. Second, you've got to analyze how much debt a company is carrying. And third, you need to study its long-term growth. Put these three clues together, and you start to get a really clear picture of a company's true worth. First up is the PE ratio. The easiest way to think about this is it's the price tag for a company's profits. It tells you how many dollars you have to pay for just $1 of its earnings. So if you look at this chart, you see company X has a PE of 15, while the average for its competitors is way up at 25. That is a huge clue. It might be suggesting that Mr. Market is selling this company at a serious discount. Next, we got to look at debt. Think about it. A company that's drowning in debt is in a really fragile position, but a company with very little debt, it's standing on solid ground. We measure this with something called the debt-to-equity ratio. A low ratio is great. It means the company owns a lot more than it owes, making it way more resilient. And finally, you look at the company's track record. Is this business actually, growing, or is it shrinking? By looking at its revenue growth over the past 5 years, you can see if the business itself is getting stronger. A company that's consistently growing its sales is increasing its intrinsic value, no matter what its stock price is doing day to day. Okay, so you've done your homework, you know what a great company is really worth. Now we get to the exciting part, putting that knowledge to use when everybody else out there is panicking. You know it's going to happen eventually, some bad headline hits, fear just completely takes over, and the market panics. And what does our old friend Mr. Market do? He loses his mind. He starts offering to sell you his shares in fantastic companies for way, way less than they are actually worth. This slide right here, this shows you everything. That steady rising line, that's the company's real intrinsic value. That chaotic, jagged line bouncing all over the place, that's Mr. Market's emotional price. And that gap, that huge gap where the price plunges way below the value, that is your opportunity. So here's the formula, nice and simple. First, you do your detective work and you find a great business. Second, you do your best to figure out what it's really worth. Third, you just wait patiently for Mr. Market to have one of his meltdowns. And finally, when the price is far below the value, you step in and buy a fantastic business at a discount. Once this idea really clicks, it changes your entire mindset. It changes how you see the market. You stop reacting to the screaming headlines and you start analyzing businesses.
And this is the real game changer. You're no longer trying to guess what the market is going to do tomorrow. Your goal is so much simpler. Buy a piece of a great business when it's being offered at a fair price. All of a sudden, a market crash isn't something to be afraid of. It's a Black Friday sale for smart investors. So I'll just leave you with this one question. Now that you know the difference between price and value, the next time the market is in a total freefall and everyone is panicking, what are you going to see? Are you going to see a threat, a reason to sell? Or are you going to see an opportunity, a chance to buy a great business on sale?